Hey everyone, welcome back to Corporate Decoder, the place where we decode the secrets hidden in those dense corporate reports to make them as clear as day. But remember, even the clearest day can hold a storm under the surface. Today, we're diving deep into Byline Bancorp Incorporated's latest annual report, and trust me, this one is packed with numbers, risks, and a whole lot of financial state strategy, so grab your coffee and let's see what story these figures are telling us. And hey, if you appreciate straightforward insights from corporate filings, make sure you're subscribed and join our Discord community linked in the description for more exclusive content. Alright, let's get straight to it. Byline Bancorp Inc. is essentially Byline Bank and its related companies all rolled into one giant financial entity. They operate across the Chicago metropolitan area and have a branch in Wisconsin offering a wide array of banking services from business loans and commercial real estate financing to wealth management and even equipment leasing. They are quite proud of their role as an SBA lender, ranking among the top originators in the country. As of the end of 2025, Byline had about $9.7 billion in assets. This is a healthy jump from $9.5 billion the year before, which shows they are growing. But let's dig into where that growth came from and how it is impacting their operations. The heart of any bank's business is net interest income. That is the money they make from lending out more than they pay on deposits right now. Byline is seeing a nice boost here. Their net interest income hit a whopping $385.3 million in 2025. That is a nearly 11% increase from the previous year. This is largely thanks to their growing loan and lease portfolio, which brought in more interest than ever before. But with great growth comes great responsibility, and for banks that means setting aside money for potential loan losses this year. Provision for credit losses jumped to $36.1 million. That is a rise of over $9 million from 2024. This increase is mainly because their loan portfolio grew and sadly they had more non-performing loans, which are loans that are in trouble. They also had to set aside some money for acquired loans from their latest acquisition. Now let's talk about expenses. The biggest chunk of that is salaries and employee benefits, which went up by about $10.3 million in 2025. This hike is due to a few things, including expenses from their recent acquisition, merger-related costs, and likely raises and bonuses to their growing team. They also had higher costs for software and system upgrades, which is pretty standard in the banking world. While interest income is the main driver, Byline also gets income from fees and services. This category was up slightly to $60.9 million, driven by things like deposit fees and income from their wealth management services. They also saw increased swap fee income, which suggests more complex financial deals happening behind the scenes. Looking at the ownership structure, there is one big fish, MBG Investors. LP holds a significant chunk of Byline's stock, about 26%. This means they have a lot of influence on how the company is run, including who sits on the board and major decisions like mergers and acquisitions. This can be a good thing for stability, but it also means their interests might not always align perfectly with smaller shareholders. Good news for investors, Byline's common stock is traded on the New York Stock Exchange under the ticker. By this means it is readily accessible to the public and has a certain level of transparency and regulation around it. When we look at how Byline's stock has performed compared to industry benchmarks like the Russell 2000 index and a few regional bank indexes, it has had its ups and downs looking back 5 years from the end of 2020. Byline has actually performed quite well, outpacing some of the broader market and regional bank indexes, which is a positive sign for their strategy. Now for the really technical but super important stuff, the allowance for credit losses. This is basically the bank's internal estimate of how much money they might lose on their loans. And leases, it is a complex calculation involving risk ratings for each loan, qualitative adjustments for unforeseen risks, and a close look at loans that seem particularly risky, the OR. DITE has actually highlighted this as a critical audit matter, meaning it involved a ton of judgment and subjectivity from management to get right. Let's look at the balance sheet. Total assets grew to $9.7 billion thanks to an increase in loans and leases, and a bit more in their investment portfolio. They managed to reduce their borrowings though, which is a good sign for financial health. Deposits are the lifeblood of a bank, and Byline's total deposits saw a modest increase, reaching $7.6 billion. A significant portion of this, over 87%, counts as core deposits, meaning they are less likely to flee at the first sign of trouble. This is crucial for their stability. Their investment portfolio in securities available for sale is worth about $1.4 billion. It mostly consists of mortgage, backed securities and government agency debt. We saw a slight decrease here, likely due to selling some assets, but also because some unrealized losses have been reduced, which is a good sign. Back to loans, commercial real estate. Loans are a big part of their business, totaling $2.6 billion. This is a significant chunk of their overall lending, and it is spread across different property types and states. While Illinois is their main focus, they have a presence in other states too. The number of loans that are not generating income or are considered non-performing increased to about $71.3 million. This is a key indicator of credit health, and while it is still a small percentage of their total loans, it is something to keep an eye on. Their allowance for credit losses is actually higher than the amount of non-accrual loans, which is a protective buffer. Overall, non-interest expenses went up by about 8.3% to $236.9 million. This is mainly driven by the higher salaries and benefits we talked about earlier, but also legal fees, data processing, and other operational costs. And finally, the bottom line consolidated net income for 2025 was $130.1 million, a solid increase from $120.8 million the year before their earnings. Per share also saw a nice bump too. This is the number that really matters to investors, and it shows the company is profitable. So what is the story here? Byline Bancorp is growing, and profitable primarily driven by strong lending and a more favorable interest rate environment. They managed to integrate a new acquisition successfully and are actively managing their capital with stock repurchase. ACEs, however, they are also facing increased credit risk evident in the rise of non-performing loans and higher provisions for losses. The company's direction seems solid with a focus on organic growth and strategic acquisitions, but they need to keep a close watch on credit quality and operational costs, especially as they approach that critical $10 billion asset threshold, which will bring more regulatory scrutiny. What is your take on Byline? Filing, do these numbers paint a picture of steady growth or potential headwinds? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button and subscribe for more corporate deep dives. And don't forget to join our Discord community, linked in the description for even more insider analysis. See you next time.